Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Dr. Jason Balara. He is the CEO and co-founder of Lark Capital Group and hosts the Know Your Why podcast. Jason is a veterinarian surgeon with extensive experience and training in his field. He additionally has many years of experience in real estate investing on the residential side with single-family flips, fix and flips, and then also small multifamily rentals. As a real estate syndicator and fund manager, Jason is focused on Class B and Class C multifamily and small businesses in order to achieve excellent returns for his investors. Lark Capital Group is also raising awareness surrounding the disproportionately high suicide rate within the veterinarian community. The Lark Veterinarian Impact Fund has been created specifically with that in mind. The goal is to create financial wellness amongst veterinarians, promote awareness of challenges facing the veterinarian profession, and have a positive impact through a partnership with Not One More Vet. So Jason, welcome to the show.
Yeah, thanks, Keith. Thanks for having me. Thanks for getting through all of that. It's funny when it's all read out to you. It seems like a lot of stuff, but I appreciate the introduction. Thank you very much.
No problem. Yeah, I know, and it's actually not as bad as some. You have a podcast as well, so I'm sure you've seen some, and it's like, oh my gosh, we're just going to kind of shorten that. And
yeah, exactly.
But
exactly.
Jason, first, I guess I didn't ask you before the show, but where are you calling in from?
I'm in Los Angeles.
Los Angeles. Okay, great.
Home currently is Los Angeles. Yeah.
Perfect. Well, I always start with really kind of where you grew up and what led you to real estate and real estate investing. So if you could take us through your story, that would be fantastic.
Sure. I grew up in Massachusetts, suburb of Boston. It's easier to tell people I'm from Boston, but I guess technically that's not exactly accurate. But my start in real estate really was as a teenager, in the sense that I found construction as a way to kind of make extra money, and we grew up with humble beginnings, I guess I'll say, and so I just always saw construction, real estate, and sort of ownership as the way out of that. And I would say that my construction and real estate career sort of paralleled my veterinary career. I was basically always doing some level of construction or owning my own home and doing those live-in flips and things like that throughout college, vet school, even afterwards in my training. So I think I joke that if I hadn't grown up in Massachusetts, I may have gone straight to construction, but I didn't want to work outside in the winter. So it made sense to just go ahead and follow the veterinary career path. And so throughout, sort of my career and afterwards, it was just a lot of stuff on the residential side. And then about 4 years ago, I really decided, hey, I want to do this at a larger scale. I want to find a way to create time freedom, I guess. As a veterinary surgeon, the only way I make money there is by doing surgery, and that requires an OR and things like that. And so it was hard to, you know, see that as like a forever plan for a number of reasons. But that's when I came across syndication. I decided, okay, look, this looks very scalable. I'd always done everything on the residential side, and I thought, well, how long is it going to take me to buy, you know, 100 houses or whatever, magical goal number you might have as far as ownership? And then you look at it, you say, okay, well, I can buy 100 unit plus apartment complex, bring in investors, and sort of grow the business and the real estate holdings at scale while also helping other people and sort of preventing opportunities. So I would say that's kind of been it in a nutshell. That whole process was, probably a 20 to 30 year
Oh, wow. Okay.
time frame in terms of starting out in real estate, because I started so young. But the syndication has been the last 4 years.
Okay. And are you still doing anything with respect to the being a veterinarian?
I am. Yeah, I love surgery. I really enjoy it. It's a passion of mine. Um, but I have created, sort of a scenario now where I can do it when I want, because I want, and kind of enjoy it much more that way.
Okay. And I know just from growing up with with dogs and stuff, just the veterinarian business has changed dramatically, even from the consumer side. And it seems like that surgery is a lot more often a solution for taking care of something where, back in the day it would have been, okay, we need to put the dog to sleep or whatever. So what kind of surgeries do you typically do? What's pretty common? Obviously, spayed and neutered, but beyond that.
Yeah, and I really don't do spays and neuters. I
Okay.
specialize in surgery alone, and generally, like, your family veterinarian is going to do the spays and neuters. They'll do some of the
Okay.
simpler procedures. What I do, I would say, bulk of it, probably 75% is orthopedic things. Dogs with ACL tears, fracture repairs, hip replacement, things like that. So more advanced type of stuff than like your normal. The family veterinarian you would go to for vaccinations. I don't even know how to vaccinate my dogs anymore. I don't know what the vaccination schedule is. I'm just so far removed from that. So I have luckily have friends in the friends in the field that are general practitioners, and I can ask them, what do my dogs need for flea prevention, deworming, vaccination stuff.
Right.
But all I do is surgery. So yeah, anyone who has veterinary questions, if they're not surgery related, I probably don't know the answers at this point.
All right, sounds good. Well, that's interesting too. That early on kind of recognized and realized that you have to trade your time for money. Being a surgeon and kind of coming up with a secondary plan, I think was good. A
Yeah.
lot of people don't recognize that until way far down the road. So you've started to already build something. Tell me a little bit before multifamily, though, when we were doing some of the residential stuff, you were doing fix and flips. Did you have kind of a flipping business going, or what did that look like for you?
No, this was more either live-in flips or helping friends
Okay.
and family with their projects. I did own a three-family in Boston at one point, and so that was as sort of as big as it got on the residential side was that.
Okay.
But a lot of, like, Burr type situations where live-in flip, refinance, sort of cash out refinance, use that money to either fund vet school or buy the next house or whatever, next project, that kind of thing. So it was definitely on a smaller scale. A lot of it out of just necessity. In you know didn't have a lot of money, so I figured out how to uh, make things work with either flipping houses, having, now we call it house hacking, but that was that was just
Right.
having
Right.
roommates when I was younger, right? That just to help pay for the bills. So I think it was just kind of doing whatever it took and recognizing that real estate was a good vehicle to do that within.
Okay. And so what year did you start investing in some of the larger multifamily beyond, just the 3 unit? And I guess part of that question as well, if you could let us know, how did you decide to make the leap from, a 3 unit being your max to, you mentioned 100 unit plus type, multifamilies?
Yeah, so my transition into syndication was in 2020, completely unrelated to the pandemic. I know a lot of people have a lot of sort of pandemic inspiration stories.
Right.
I had already made up my mind that I was going to sort of move in that direction before the pandemic sort of officially hit us. And the way I sort of eased or sped up that transition, I guess, was through mentorship. First thing I did was get a mentor, went through a mentorship program, and that is, I think, something I definitely recommend to people, whether it's a paid mentorship or organic. There's a lot of different opportunities, but I believe you either have sort of time or you
Hmm.
have to pay to play. And so, if you're young and you can take the time to just kind of work your way into it, great. You may not have to pay for a mentor, but you might have to go work for someone for free, or just kind of show them that you're serious about it. Or if you have some money and don't have the time, then you can go that sort of paid mentorship route and find someone that will take you on as a mentee, and use that again as a springboard. And you still got to put in the work and everything, but getting that learning curve shortened is very helpful.
Yeah, I would say so as well. It really, you have an ability to kind of lean on somebody else's experience. And so when you're diving in, especially when you're doing something where you're raising capital and it's, you're going to have other investors, money at stake, definitely want to have an
Yeah,
experienced team. And that's one of the things multifamily can definitely do. So tell me a little
yeah.
bit about where you invest with the multifamily and kind of what your portfolio looks like today.
Sure. My main market of focus has been the Atlanta MSA. That started, I chose Atlanta sort of to begin with, in large part because of my mentor, and I actually had um, friends there, so I had sort of boots on the ground. But as it turns out, I actually really love the market. I think it's I like to look at it as it's always on like the top 10 in terms of growth, but it's not
Mhm.
usually like 1 through 3. So it's not really a boom or bust market. It truly is a very large city that is growing. They have a lot of new industry coming to the area. Interestingly, film is a big growth
Yeah.
driver there. Atlanta is like now the Hollywood of the East, I guess. Um, and so there's a lot of there's still room for growth sort of outwardly from the city center, and it's still below average in terms of the national rents. So you have a lot of opportunity there in the coming years. No market is perfect. I think they have some struggles with the infrastructure to handle all of the growth, but they are
Mm.
definitely working on that. And there's been legislature changes very recently that are positive developments for that situation. But contrast that to maybe say like the Florida and Texas markets, where those are great growth markets, but they've been hit really hard by insurance lately and insurance growth. And so
Right.
there's just there's challenges everywhere you go. But I've been very happy with Atlanta. I do have some, we do have some holdings in the portfolio and in other markets. We just closed a deal in Atlanta as part of our fund, or sorry, in Phoenix, Arizona, as part of our fund. The I think for me, I like to stay fairly focused in terms of where I'm going to be the operator, because I have boots on the ground and I have a team in place. I already know kind of what the expenses are going to be there. It's easier to grow in one market, I think, than it is to be sort of simultaneously trying to grow in 3, 4, 5 markets.
Yeah, I think so too. And I think just knowing, as you naturally, just by having an apartment complex in a certain area, you get to start to know somewhat of the city,
Yep.
but there's always areas that you learn, hey, probably next time I'll stay away from that area or whatever it may be. So,
Yeah.
what does
Yeah, for
the
sure.
portfolio in Atlanta look like? How many different apartments and number of units?
Yeah, currently we have 236 units in Atlanta, and that's spread across 3 different assets. So anywhere from 70 to 90 units per asset.
Okay, okay, that's fantastic. And in the bio, it mentioned Class B and C, and
Mhm.
so these are going to be value add opportunities.
Yeah, yeah. Value add, I think, is to me the strategy that makes the most sense. Like I said, I have a long construction background, so that construction side of things doesn't scare me. I understand the language. I can talk to contractors. I can uh, know if the pricing isn't really consistent with what it should be. But I do think, especially, we're experiencing this now in the market when the interest rates rose so much, cap rates expanded. They had been very compressed. If you're not forcing value and you're just relying on the market, then I think you're going to run into challenges in these up and down cycles, depending on what your exit strategy is. So I like the ability to actually add value to the property through a renovation program.
Okay, and what are some of the levers that you're pulling to to kind of increase the value on these properties?
We uh, on ours we've done some pretty large scale renovations. I mean, we've done uh, exterior siding and paint. We've done new roofs where indicated. We've been renovating each of the interiors as they've become available, making changes to the landscaping, the grounds. I think we the important thing when the market shifts, I think, is just pivoting strategy. And so,
Right.
kind of realizing that, okay, expenses have gone up. What do we have to do, particularly on the interiors? What do we have to do to still achieve the rent bumps that we had projected, but also um, maybe try and look at ways to increase or decrease expenses? So on the construction side, that's what we're doing. We're always looking at those numbers. What can we do to sort of increase value with maintaining or even reducing expenses? And I think it becomes very much a high level numbers game where you're just looking at where can I make these tweaks along the way to ultimately improve NOI.
Yeah, makes sense. And what are y'all seeing right now as far as rent increases? Have you been able to kind of keep those, or is that kind of flattened out in the Atlanta market specifically?
Yeah, it's we've been able to keep them. In fact, we've been, for the most part, been able to achieve above what we pro forma'd for our rental increases, which is nice. Um, Again, it's balanced with the fact that there's a lot of eviction delay and things like that. So you have good and bad, I think, in whatever market that you're in. But as far as the rent bumps and what we were hoping to achieve, we've found that has been still a very strong positive in terms of what we're doing at our properties.
Okay. And you mentioned, kind of evictions, and is Atlanta fairly easy to? Is it a pretty landlord friendly state, Georgia, or
It's supposed to be.
okay?
That's one of the things I alluded to in terms of infrastructure that I think they weren't ready for. So with the pandemic, there was, I think, in Atlanta MSA, every county is a little different, but specifically about a year and a half eviction moratorium. And
Hmm.
so the backlog of evictions was pretty big in particular certain counties. So the backlog of evictions was pretty big, and they didn't have the infrastructure in place to like handle it all. So evictions got very backed up. It took much longer than normal to process. It took much longer than normal to get set outs, things like that. But like I said, they have been changing some legislature very recently, a week and a half ago, maybe. One of the DeKalb County approved $1 million+ to sort of put towards this exact problem. So they're making the necessary changes, but it's not an overnight change.
Right, right. And what about property management? Do you have one company that you work with there in Atlanta, or is it kind of property specific?
Yeah, it tends to be property specific. In a lot of instances, it kind of depends on the size of your assets and how many you might have. Um, it also depends on the vintage, basically. Like a smaller C class property, you're going to have a different subset of property managers available to you as you would for like an A class, 300 unit type brand new property. So you
Right.
have, I think that's actually a great question and a great point to bring up for people listening. Is your property management company is going to have a certain capacity for which they can handle. And so if as you're taking on new assets, or if you're looking to make a move, you need to have very serious conversations when interviewing them about, do they have the capacity to handle these, additional assets, whether that's manpower or their own infrastructure, and find them. And I think my experience has been that different property management groups have different strengths. And so I always break it down into sort of three components of asset management. You have the construction side, you have the leasing side, and you have the financial side. So there's kind of three different parts that they're all intertwined, of course, but that I find are important. And I think it's very hard to find one property management group that might be excellent at all three. And so I think you have to look at what you have within your own internal team. And since they are, you're partnering with them really in these management roles, you got to figure out, okay, what's their strength, what's my strength, how can we sort of have complementary strengths, and where do we need to fill the gaps?
Yeah, that makes a lot of sense, Jason. And what do you usually bring to the table, or what part of the process as an operator are you focused on?
Yeah, I focus on the asset management side. I've
Okay.
also been in acquisitions for our Atlanta properties, but I think given my construction background, the asset management side tends to be where I feel most comfortable, and where I feel I can excel and help the team the most.
Yeah, makes sense. And it's kind of unique to have a fund specifically for called at least Lark Veterinary and Impact Fund. Can you maybe talk a little bit more about that? And
Yeah.
maybe at the head of that, kind of I was totally unaware that there was a disproportionate number of suicides within the veterinarian. Do they know what that's attributed to, or uh, what's going on
Yeah,
there?
I mean, it's a combination of factors. So the unfortunately, between veterinarians and dentists, we tend to be sort of battling for that, top spot in terms of professions with the highest suicide rates. Not a very good honor to have, but we tend to
Right.
be, kind of up there. And I think the reasons are similar between the two professions, but essentially, as veterinarians, we go to school for a long time. The student debt load on most veterinarians right now is tremendously high. So they're coming out of vet school with two, three, sometimes $400,000 in debt. As we all know, interest rates are high, so it's like having a mortgage without a house.
Yeah.
And so that's one. I think there's a lot of financial pressures. Nobody, literally nobody I've ever known or ever heard of becomes a veterinarian because they think they're going to make a lot of money. They want to help animals. That's the reason. And
Yeah.
so, taking on all the student debt, taking a job that is not equivalent in terms of pay to like an MD, is not. None of those things are considered ahead of time. But then when you finish school and you go out and get a job, you're faced with the very real reality of that. And so, in order to make ends meet, a lot of them have to work extra hours, take on extra shifts, pick up a side hustle, whatever it is. So there's kind of financial pressures at both ends. In addition, you have things like compassion fatigue, which is obviously we care very, very much about animals and helping them and helping their owners. But euthanasia is a part of the equation, and in some cases, that's a service that we provide. But there are also some pet owners that will use that as a convenience. They call it a convenience euthanasia, or we call it a convenience euthanasia. I'm not sure that the client that is doing that is refers to it that way, but ultimately, they don't, they're moving, they don't have they had a child, something like that. They just don't have the room in their life for that pet to be around. And so again, vets, they want to help pets, and it's like, we try to do everything we can to sort of get them in a better situation, but sometimes that's not an option. So those are some of the struggles, and I
Sure.
think it's probably in a lot of ways maybe a personality type. It's a very introverted group. I think it's kind of just our heads down and let's do the work. So that is, and I've been doing it long enough that I have taught other residents surgery and things like that. Like I know a lot of young people in the space, and I see kind of the struggles they're facing. And going through COVID was a challenge for people. The During COVID, the number of pets in the U.S. doubled, and the number of vets and the number of technicians went down. So an already overworked group just got even more overworked, and so it's again a number of factors. And so when I decided to start Lark Capital, I was looking for a way, sort of at the time, really just how can I do something to better the position of my family, basically my immediate
Right.
family. That was the whole point there. And I felt, for whatever reason, compelled to sort of keep the two worlds separately. Like, this is my real estate job over here, this is my veterinary job over here. Don't really combine the two. And now I just realized that was probably a mistake. I think there's a lot that I can do in terms of helping veterinarians in with financial education. You don't get time to study finances while you're going to school for 8+ years to become a veterinarian, and so
Yeah.
I thought I could help on that front. You don't have to be a veterinarian to invest in our fund, but if every investor in the fund is a veterinarian, that will make me very happy, because that means I know I'm helping that many veterinarians, sort of move forward in their financial piece. But ultimately, what we're doing is we're donating 25% of the profits from the fund on the back end to Not One More Vet, which is an organization dedicated to helping struggling veterinarians with their mental health, and sometimes actually in difficult financial situations. So it
Mm.
seemed like a good way to kind of wrap it all together and bring two worlds that I guess I had been separating and probably shouldn't have, but sort of bringing it together and trying to do some good.
Yeah, that's neat. What about raising capital? Are you focused on veterinarians rather, as well, or is that pretty well just? I guess you mentioned educating them, and I know that's kind of a piece of the puzzle.
Mm.
Making sure people understand that's an option. Um, so what's
Yeah,
the
I mean,
focus?
I would, like I said, I would love it if all of the investors in the fund are veterinarians, or at least from that, sort of field. There's a lot of ancillary and support staff that goes along with veterinarians in the veterinary industry. Again, it doesn't have to be, could be someone who loves animals and has a strong affiliation with their veterinarian. And there's a lot of people like that out there. I
Yeah,
just, the idea is to help people. And so if even anyone who invests in the fund, right, like at the end of the day, the profits are going to go help veterinarians. So whether you're a veterinarian or not,
yeah,
veterinarians are going to get helped. So it's kind of it it took me I guess 3 years before I figured out how to tie it all together. But I guess it goes back to mentorship. I had one of my mentors. She was like, "I think you should do a fund," and kind of talked through it with her. And this is what made sense to me, kind of when it all came down to it.
Yeah. Well, and that seems like a very large percentage as well. So you're definitely serious about the cause, and that's very neat to hear. In the bio, it also mentioned small businesses in addition to multifamily. Are you syndicating businesses, or how does what did that look like?
Yeah, the idea behind that is that we have right now, in the real estate world, and obviously the market's still a little bit volatile, and so who knows exactly how it's going to shake out over the next 6 to 12 to 18 months. But bottom line is it's becoming harder and harder to, at least in the markets that I invest in, sort of foresee a lot of cash flow coming out of the real estate. I think we can still achieve good returns in a value add scenario, but the cash flow along the way is lower than it might have been, say 5 years ago. So what I wanted to do with this is really kind of came from just my own, again, like looking at what I would do for myself in terms of my personal portfolio, and then deciding that I wanted to put that out there to investors. But there are a number of sort of small businesses that are pretty high cash flowing with low overhead, things like car washes, laundromats, nail salons. I guess you could lump self-storage into this. There are scenarios where you can use the business to provide a lot of cash flow, and then again, we're going to still combine that with the real estate benefits. So the idea is just kind of to layer that on top of what we're getting already in terms of real estate.
Okay. And do you have any specific ones that you're raising for right now as far as the businesses go?
At the moment, I would probably leave that. I don't want to put those details out there. Like I said,
Sure.
I mentioned the types that we have, or that we're going after, is those, kind of, anything that is low overhead, sort of high cash businesses that it's easy to find an in-place operator is really what we're looking at. I have this construction background. Buying a construction business makes a lot of sense to me. It would probably help my real estate businesses, but I
Right.
don't feel that fits the model of this fund, because construction tends to have a lot of overhead. So it would be something I would definitely consider in the future, but it's probably not going to be, it's not something that we're looking to fit in the box as far as this, as far as the fund goes.
Okay.
So
And
we have yet to close a business within the fund, but the fund's only been open for a couple months.
okay. That's fair, certainly. And obviously, at some point before the end of the show, we'll kind of direct people how they can find out more about you, and if they want to start a relationship to be able to hear more about any opportunities that come up. We'll certainly give the audience an opportunity to do that.
Awesome.
Tell us a little bit about those businesses, though. Are they going to be in Atlanta as well, or are you more broadening your search when it comes to that specific type of investment?
So the idea for me is that the businesses will be local to me. So
Okay.
as I said, I want in-place operators, but I also want the opportunity, if I need to be there, and
Okay.
check in and that sort of thing. So the idea is, I'm in LA, within an hour, 2 hours of LA. There's plenty of laundromats, nail salons, car washes.
Right.
There's
Yeah.
lots of that here that we can access. So I think we've got a large market to work from. I wouldn't be opposed to something in Atlanta, like I said, because I have boots on the ground there. So I think it would be
Mhm.
a reasonable option. But I don't want to go, sort of countrywide, because just from a simple logistics standpoint, it's like, well, right now I can go to Atlanta, see almost everything I need to in terms of holdings. If I start buying, if I buy a laundromat in Texas, and then I got to go to Texas for
Right.
only to see this laundromat, I'm not one that wants to be on the plane all the time. I guess I'll put it that way.
Right. Exactly. And with the multifamily, obviously, just across the board, the market is still uh, going through some difficulties, whether it be with the interest rates, whether it just be with kind of a spread between what sellers are trying to get for their property versus what the newfound values are with those
Right.
expanded cap rates. What type of property are you looking for today when it comes to multifamily?
Yeah, so it's a great question because that has actually shifted. For me, I think given the, I guess, challenges that you face in an older building and in a smaller building, mainly is just that sort of efficiency of scale. So for me, definitely looking at newer and bigger. So definitely greater than 100 units, um, B class. So newer than 1985 or newer if we can do that. You just the older, I mean, it makes sense, right? The older the building, the more repairs and maintenance there would be, the more you're going to spend on capex. Kind of all of those things add up over time. But I actually think what makes the most impact overall in terms of sort of being able to manage the asset is just the number of units, basically the ability to use efficiency of scale.
Yeah. Okay. Sounds good. And when you're not investing in real estate, what and maybe not doing your surgeries, what do you do, Jason?
Um, I love exercise. I play soccer. I like to go to the gym 3, 4 times a week. And outside of those things, I just love spending time with the family, playing with my
Yeah.
kids. That's the main. That's really where I like to spend my free time is playing with the kids. My son is 4.5 and just started playing soccer himself. So
Wow.
something that's really exciting for me to get to. Who knows if he'll stick with it? But I've been playing for 30 years, so he's. I would love to be able to play together. I guess in some sort of meaningful way. I gotta stay young enough to play in a game with my son someday. That's my goal.
There you go. There you go. Yeah, that's funny. I just mentioned that to somebody as well. Just for me, my daughters are older, but just trying to get to a spot where when if and when we have
Yeah,
grandkids that I'll be able to keep up and
yeah. Yeah, that's
so
like LeBron talks about basically the only reason LeBron's still in the NBA is so he can play with his son, I think is ultimately what what he's waiting for. And I'm like, well, I'm older than LeBron and my son's younger than his son. So I'm going to be quite a bit older when if I get that opportunity, but I'm going to try and make it happen.
yeah, for sure. What you mentioned having a property, and I don't know how long you've had it, but a property. I think you said I want to say you said Phoenix as well. Yeah.
Yeah.
What are some of the differences, if anything, that you've seen between the two markets?
Yeah, I actually think that's what I like. They're actually fairly similar in terms of growth and like I don't. There's probably a better term for this, but the ability to grow. So just space. Like for example, Austin exploded. That was number one on the growth cities for the
Right.
previous few years, and Austin's a small city. There's just not that much
For sure.
space to go, and so I think that at some point again you run into challenges with just space, and in a way that's good because you have some constraint to new supply, but also at some point that it's a very delicate balance, right? And so I think you have to in addition to bringing in new housing, you have to be able to bring in all the other stuff, right? So if you're bringing in a whole bunch of new housing units, you also need to have new grocery stores and schools and like kind of all the stuff that goes along with living in those houses, and cities like Phoenix and Atlanta have that space. um, there's certainly differences in terms of climate and different things you might worry about in your um, uh, like construction and what you've got to deal with there. Arizona is making a lot of, and Phoenix specifically, they're making a lot of adjustments to help handle the water supply. So there are certainly different things that need to happen, but I actually think from a overall growth and ability to grow more, I think they're actually very similar.
Okay. And then how often are you having to travel out to, say, Atlanta, when it comes to asset management and that kind of thing?
I would say, I mean, I would say on average, been there at least once a month since
Okay.
we've sort of started purchasing there. It's been a couple of years. I would say at least once a month between myself or one of my partners. I tend to be the one that goes a bit more frequently. If we're trying to get through a big project or we've got a lot of units that are under construction, we'll go more frequently. But I would say on average, uh, once a month at least.
Okay. And typically when you're heading out there, what are the types of things that you're checking on? Obviously progress if there's some, construction
Yeah.
projects underway, but what are some of the things that you do on those visits?
Yeah, and I would say that's the main thing. A lot of the stuff in terms of asset management from the other two, like leasing and financial reporting, you can do that remotely.
Right.
And a lot of the construction management you can do remotely as well. But sometimes when you get in a scenario like for example, I told you that eviction and moratorium cause a lot of backlog. So what happens is we'll sometimes get a sort of chunk of units that become available because they were able to process a group of evictions, and you might have some other tenants that are under eviction elect to leave because they see that evictions are happening. So you might get a larger number of units become available at once. So that's a lot of times what I think is important is to make sure that we're on track, kind of going through the units and getting a scope of work and okay, here's what we're going to do. Here's how we're going to prioritize, right? So like another example of that would be, if you have a property with 1, 2, and 3 bedroom units, and you have available product in 1 bedroom units, but you don't in 2 bedroom units, and now you get a grouping of uh, units that become available due to move outs of whatever type. I'm going to prioritize those 2 bedrooms as getting done first, so we can have them,
Right.
have the move in sooner on the 2 bedrooms, right? So wherever you have the demand, you need to be able to address and fill that demand, and then um, in the beginning of a value add project, a lot of times you have other things happening aside from just interiors, right? So you're trying to coordinate roofing and playground and paving and all of this. So um, when there's a lot of different moving pieces, it's also helpful to be there as well for that. So making sure, okay, how do I coordinate? Like we need to trim trees. Well, I'm not going to do the parking lot ahead of that because those trees, it's going to cause damage to the new parking lot. So it's just evaluating what's priority and putting those pieces in places.
Yeah. Okay. Very, very interesting. And Jason, I'm going to ask a couple extra questions here, that I ask really every guest. And number one, on that would be, well, before we actually get to those, why don't you tell everybody how they can find out more about you, how they can kind of, obviously, listen to your podcast as well, know the why. Maybe you can give us a little bit of insight on that first, and then how
Yeah.
people can find out more about you.
Sure. Yeah, you mentioned the podcast. It's called Know Your Why, and it is. I like to say it's real estate inspired. I think one of the things that has always drawn me to other podcasts and sort of the story. It's the stories. It's the stories behind success and kind of what drives people. And I think I'm a big sort of mindset guy. I love sort of almost experimenting on myself. What can I do to change my mindset, push myself, that kind of thing. And so you get those inspirations from other people. And so I always love kind of that aspect of the podcast. I think there's a lot of ways to find out the nuts and bolts of real estate, and I don't know that you could truly learn how to syndicate from podcasts, but you certainly can, supplement the reading or mentorship or whatever with that. But I think ultimately at the end of the day, you've got to, kind of figure out what's the thing that's going to get you through the days when the times are hard, because that's to me, that's my why. That's what matters. In terms of reaching me otherwise, I can email me. It's jason@larkcapital.com. Our website just got a really nice makeover that I'm super excited about. Literally just launched last week. So larkcapital.com. Please check it out if you're honestly just interested in feedback, because I'm really excited about how it came out. And so those are probably the best ways. I'm pretty active on Instagram and LinkedIn. Instagram is @larkcapital. It's Jason Balara at LinkedIn. So any of that.
Okay, cool. And on the revamp on your website, just curious for myself, but do you show some of the projects that you currently have, or what are some of the updates and things that you've done to it?
Yeah, we definitely have. We show our current assets under management. We
Mhm.
have a lot of it is because the fund is kind of front and center right now. A lot of it is sort of fund centric, if you will. But it has, we have a media page. We have. It's just I think a easier to navigate kind of structured website for people to find out whatever educational content, and then also just there's an easy way to find me there on podcasts that I've been on or linked to our podcast, and our website, or it is the website, but there's a lot there about kind of what we're about.
Okay, great. And a couple of other questions, if you have just a few more minutes.
Yeah.
One being, what advice could you give somebody who's maybe just starting out with their investment journey?
Mentorship has been huge for me. I have I have I never really thought about it, I guess, a lot of the ways along the way in life prior to the syndication journey, but I have had a lot of good mentors in my life, coaches, my uncles, like just people that have been a big part of who I am now. Mentors in the veterinary space, and the same is true in real estate. And so I think you really have to figure out a way to make that happen, whether it's paid or organic, because it will save you a ton of time. It will save you. I know a lot of the mentorships programs can be expensive, but I guarantee you will save you money over time because you won't have as many mistakes, I guess, that can be costly, especially in this business. And I think so. I think finding a way to align yourself with a mentor, whether it's organic or paid, is probably one of the first steps that you can take. But ultimately, I think maybe the best advice is then just don't quit. You gotta take
Yeah,
action and don't quit, because it's a long game.
for sure. No, I think that's great advice. And how about a book recommendation for the audience? Anything you've read recently that you'd like to
This one's
recommend?
easy. This is what this, because this book changed my life. But Who Not How.
Yeah.
Um, it I am a DIY guy through and through. I like all of my past investing has been in large part my sweat labor, me sort of doing everything. And if you want to be a business owner, if you want to be an entrepreneur, if you want to be a true active real estate investor, you've got to start learning to delegate. And the funny thing is, it's like it's not just delegate like, oh, I'm going to have property managers. It's like I, I'm not going to go to the grocery store anymore. I'm considering like getting a driver,
Yeah.
like things like you really look at like where is your time being, where's your time best spent. And so it really was it's been a big mindset shift for me having read that book. So I think it's a great one for people to read. It's maybe not the first one you read, but if you're serious about this business, you got to read it.
Yeah, for sure. And that's Dan Sullivan and Ben
Yep.
Hardy.
Yep. Yep.
Great book for sure. We get that recommendation quite a bit, but
Yeah.
I agree. It's an awesome one. Um, well, Jason, I've really appreciated your time today on the show. I think it's fantastic what you're doing. Not just to launch a fund and help people from a financial standpoint, but also what you're doing there with putting aside a certain portion of the proceeds and profits to help benefit that charity.
Yeah, I appreciate it. Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.